Hello, everyone. Welcome back to the Trailline Podcast. I'm your host, Richard Moglen. Joining me today is a very special guest, Jack Schwager, the author of the well-known Market Wizards series, with most recent edition being Unknown Market Wizards. So, Jack, it's a real pleasure to have you on here. Welcome to the show.
Yeah, thanks. Appreciate it.
No problem. And to start things off, I'd love to hear about kind of the story behind the series. So could you tell us a little bit about your background, how the Market Wizards series came to be, and the whole story behind that occurrence?
Sure. So the idea for Market Wizards, the original one, was something that I had for several years before I actually did the book. The genesis is probably that I took a sabbatical to write another book before Market Wizards, which was a complete guide to the futures market, which is a different type of book. It's an analytical book. It's like almost 800 pages. Like I say, I took a sabbatical to do it. It took a whole year to do it. And I was just trying to write. I didn't think at the time, this is back in 1984, I didn't think there was a really good general text on analyzing the trading, the futures market. So I figured I'd do it. Mm-hmm. And that got me started in writing. Although I was writing some articles before then, but that was the first book. And I got approached a couple of years later by an editor, have lunch with an editor from a different publishing house. They liked the book and they wanted me to do a whole series of analytical books. And I said, thanks, but no thanks, did it once and no desire to do it again, although I did end up doing it again. But at that time, I didn't think I was going to, because you do a book like that for only one reason. It's not to sell copies, the more actually, I sort of have a rule that the more formulas you have, the less copies you'll sell. And mm-hmm. It's sort of, actually the more intense you make the book, it doesn't work if your goal is to sell a lot of books or make money, you don't want to do that type of book. But I wanted to establish it as myself as writing what I thought was a good, really good, solid text. Right. But subsequently, what I want to do is really reach a wider audience, which that book is more specialized and really for traders who are really serious and maybe some people with a little bit of analytical background. And I wanted to reach a broader audience. And I knew some really good traders, like Michael Marcus is the first chapter in Market Wizards. I also knew Bruce Governor, and so I thought that this would be a good idea. And mm-hmm. So when I was pitched with the offer to do this series of analytical books, I said, not interested, but I've had this idea. And the reason I didn't do it is because at the time I was a research director, which itself is kind of a full-time job. And sort of, it's well more than a 40-hour week by itself. So writing a book on top of that it really is a strain. But I thought it'd be a good idea, and I didn't want to do it at some level. So I tossed this idea out, and the guy said, sure, do it. So that was the catalyst. And basically nights and weekends is when I wrote the book. So the interviews themselves really, other than some of them required trips, different parts of the country, but, a number of them were in the New York area, which is where I was. So the interviews themselves are really not what took a lot of time. It's really the actually putting the book together, which is what takes the time.
And outside of the traders you knew, how did you decide who to actually interview for that first Market Wizards book?
So one thing I did was every time I interviewed somebody, I asked them who they thought I should interview.
Right.
So that was helpful. That was a good thing to do. And I knew some people like that I didn't know personally, but I knew of them. Mm-hmm. And I don't think I knew, like I say, Marty Schwartz. I didn't know personally, but I was aware of him. Mm-hmm. Somebody like Jim Rogers, I knew, it wasn't that far after he had left George Soros, the Quantum Fund, kind of knew him by reputation as well. So there were some people that I knew of that I thought would be good interview subjects. And between the ones I knew, the ones they recommended, the ones I knew of, I basically had, the core of the book, basically.
Gotcha. And I do my own interviews with traders, as I just mentioned to you before we start recording, and I find it's quite easy actually to ask good questions because you've already got a little bit of experience, you know what's going on. Could you talk a little bit about your own personal investing and trading background and how you develop that kind of specific knowledge, which then you could go out and ask these market wizards and learn even more from?
Right. So I had good market knowledge. I
Hmm.
wouldn't say I certainly wasn't a good trader. In fact, one of my motivations for doing the book was, hey, it's a good way to pick the brains of
Exactly.
some of the best traders around.
Right.
So there was that motivation. Hey, it might help my own trading. So it wasn't that I was a good trader, but I understood markets, and I'd done a lot of analysis. So regardless of what method the trader used, I could usually speak intelligently
Right.
about it, whether it was technical or fundamental or whatever. So it was that background that was useful more than, and I had traded, but it
Hmm.
wasn't any trading expertise for sure that was helpful. Uh, the one thing I did, I don't know, probably did it from the beginning. I certainly have been doing it, you know, in other market wizard books, but I think I probably did it from the beginning, was to that even though I had a list of questions,
Hmm.
they were just kind of the safety net. I didn't go in and like flip cards. I had a little stack of index cards, but what I would do, and what I still do, and what I think is really important, and it's advice I give people who do what I do, is don't don't go in and with a set of questions that you're going to hit the check the boxes, right?
Right.
Because the worst type of interviews, and I've been on the other side of a lot of interviews, but the worst interviews I have, where somebody comes in, they ask a question, and no matter what you say, they go to the next question. It's like you can just hear the checklist.
They're
They're
less
not
organic. Yeah.
engaging. They're not engaging. So the most important thing is have a conversation. And the most interesting things that ever come up in the interviews don't come up because of questions I ask. They come up because of answers people give, which then lead to other questions, which eventually leads to something. So it's really important to approach these things in having an engagement with the person,
Right.
not to go in with a set of checks to fill. And so that's kind of the most. It's not. I wouldn't say it's a lesson I learned. I think I did that instinctively from the beginning, and it's something that I think that I did correctly, and I've never changed.
For sure. And while you're doing those interviews, were you ever very apprehensive about approaching somebody, or actually during the meeting, you were kind of extremely nervous and scared because some of these were very established traders and fund managers. So I just wondered if you ever had that type of experience
Yeah,
for the
I
first
guess
book, especially.
I guess I've never been intimidated. I've certainly felt that people I interviewed were just way smarter, way better than I am.
Hmm.
But I always felt that I was good enough to have the conversation.
Right.
So I always had enough confidence that I can talk to almost anybody if it's a subject that I have some knowledge on, and and not come off like somebody doesn't know what they're talking about. Nor
Right.
do I pretend. If I don't know something, I don't pretend that I know it,
Right.
uh, which I think is another important thing. If I ever get questions, sometimes people ask me a question, and it's hey, not my area. I don't know. So don't. I never try to fake knowledge. So as long as you stick to areas where you have solid footing, then no, I can't say I was never intimidated. I was never nervous. I was anxious in some respects in certain interviews because of there was a certain pressure element. So, for
Hmm.
example, Tom Baldwin, who was kind of maybe the most famous certainly one of the most famous floor traders of the time of the era when I was interviewing. So this is a guy who would be in a T-bond pit, really trading like these huge size, and aggressive, and certainly known by everybody.
Hmm.
Now he didn't want to do the interview. Uh, I'd interviewed somebody else, Brian Gelber, who was a trader in his own right, had his own trading shop, and he was a friend with Baldwin. I think he may have pushed Baldwin a little bit, or at least got him to agree. And I was in Chicago when I interviewed Gelber. It happened to be St. Patrick's Day. And first of all, Baldwin didn't want to do the interview. And so I had to wait till, first of all, the end of the trading day, comes up to his office. And, and as I'm doing this interview, people are coming up and they say, when are you going to be at the bar? It's like,
Right.
He's like waiting to just go and have drinks with his buddies. He doesn't want to do the interview. And I kind of know that the minute, I have like 3 seconds between a question, another question, he's gone. And so every time he answers, like as soon as he finishes, I've got enough. And again, I'm not working from cards, so it has to be impromptu, so I can't hesitate. And so that was kind of pressure because I knew as soon as I had any hesitation at all, he's gone. That's exactly. I think I use the analogy in the chapter. I think I used it with something like you're trying to take a picture of a bird on a wire, and the slightest move, it's gone.
Yeah.
And that's the way I felt. I felt he was like a bird on a wire, ready to fly off. And sure enough, the first second I hesitated, he was gone. So that was kind of like that was an interview that I remember because there was pressure. And it was kind of thinking. There was another interview. That was the one I kind of think is the best example. Where there was some pressure during the interview. There were interviews like Bill Lipschitz, which ended up, it was a currency trade. Ends up being first chapter in the second Market Wizard books, New Market Wizards. Now, sort of, I know he had interesting stuff because he traded for Solomon. I knew he traded billion-dollar positions. So I'm talking, a guy who's going to have some interesting stories. And, we talked for a couple of hours. He's just not going anywhere. This is going to be like deadly. And then we break. He ordered some Chinese food. We break. We're having the food. And then he starts talking, the tape off, and then we get back on. But, and the tape, and again, but it took literally, I think, everything in that chapter probably came after about 4 hours of interview. So like literally the first 4 hours of the interview ended up being tossed.
Yeah.
And that was kind of an extreme example of that, but that happened in a number of interviews where you just have to keep at it until you start getting something interesting. And so now, you don't have this luxury. You do a podcast, you've got to get it right when you're doing it. Now, when I do the book, one advantage I have is, sometimes I've done as much as 10 to 15 hours of interview, to get to distill it down to the book, to the essence of the book. So that gives me the advantage of being able to extract the best stuff and to mold it and sort of, which is something you don't have when you're doing, interview like a podcast interview. So that's one advantage that I have in the types of stuff that I do.
And I want to ask you whether there was one kind of favorite question that you love to ask all these top traders and investors that you always found that there were very interesting responses to.
Yeah, my favorite question is, what's the worst trading experience you ever had?
Yeah.
That's my favorite question. Because for two reasons. One, it leads to the best stories. And two, it leads to the best lessons. Because people learn the most. You learn the most from the mistakes you make.
Right.
And most traders, if you ask them, what's your best trade? Kind of stumped, they had so many trades and so many good trades, but you ask them the worst trade, they'll usually remember the worst trade or their most painful trade. And it may go all the way, and often it goes all the way back. You talk to somebody like Ray Dalio, who ends up, managing, being in charge of the largest hedge fund ever, and probably, Bridgewater, at least at the time I interviewed, I haven't come up with the statistic, but at the time, they had made the most amount of dollars for investors because it's a combination of, he didn't have the best performance, neither in return nor return risk, but the combination of having a huge, like a mind-boggling amount of money under management and yet delivering substantial returns on that combination, made him like in his own
Right.
sphere.
Right.
Uh, so so that's why I say that's why he ends up having made the most money, at least at the time, for investors of any hedge fund that ever existed. So somebody like that, and he has all these years of experience and running the hedge fund. But if you go back and ask him his worst, but when he starts talking about his worst experience, it's back when he was like sitting, I don't know if he's a broker, I forget, he was a trader or broker, whatever, but he wasn't managing a hedge fund or whatever. He's kind of trading his own account. And he
Right.
remembers a time he was long pork bellies, and every day, and he talks about this is only people as old as Ray and myself know this, or work in that environment. Because when we came into the business, forget computers, with electronic screens, and we had literally these big, when you worked in a brokerage for a large brokerage firm, you had these wall-sized boards that the prices would change, and you would hear the clicking, every time the prices change, or the clicking of the
Hmm.
of the prices changing. And when he talks about being in a long pork belly position, and every day it was some sort of report, and every day the market opens up, limit down, and it's like clicks down, limit down. And he talks about like it's like an electric shock of that experience, and it's very visceral because you have
Right.
the sound of it and the whole thing. And I could really relate to that because I know the exact environment he's talking about. But the interesting thing is when he talks about his worst experience, he goes all the way back to those early days.
Yeah.
Not and when he was losing, who knows, probably a trivial amount of money. Because I mean, to him it
Yeah.
wasn't trivial, but it was own account, maybe in a couple of contracts. And he doesn't go talk about when he might have been losing billions on a trade because of the size he was trading. It's when he was losing thousands on a position, but it was that experience of being stuck and not being able to do it after he made the mistake.
Right. You learn the most when you're making the mistakes and are in your formative years as a trader.
Yeah, yeah.
Yeah. Yeah. And so a lot of our audience at Traderline are kind of growth stock traders, similar to William O'Neill or David Ryan. So
Right.
I was curious if you remember any tidbits from your interviews with either O'Neill or Ryan that would really stand out to people, or you think they would find them interesting.
Well, I mean, the main lesson, and this is you get if you read their books or listen to them. I mean, their approach. I mean, it's a lot of things and a number of things that are involved, but the biggest thing they've done is to go back and look at what are the profiles of the winning best winning
Stocks. Yeah.
trades, and it usually will involve buying stocks that are going to new highs and stocks that are among the strongest. Uh, Actually, so it's got to be an approach that feels right, yeah, that works for you.
Right.
So it's difficult to do because you're always buying stocks when they're at highs, and you could be subject to a lot of times false breakouts and stuff like that. So you've got to have the attitude and profile where that type of approach works. But that's from what if I think what's maybe most important to their approach, it is that element of buying strength
Yeah.
and looking at the profile of those things that went on to be the biggest winners. And that's opposite of what a lot of people do. That
Right.
you could do the opposite thing and still be successful. It just means that it's a certain type of approach that is only going to fit certain types of people. So that's what I guess sticks most in my mind about both of them and their approaches.
Right. And during the interviews, were there any special stories that came up or really significant?
Well, actually,
Yeah.
with Bill O'Neill, like, if that's what I really remember, what I remember is, I mean, here's a guy who owns the company, who's made, God knows how many, tens of millions of dollars.
Yeah.
And, even at that point, he was well on in years.
Yeah.
So I kind of picture, I kind of imagine I'd be, interviewing him in his nice office or whatever. And I mean, there he is, like in the middle of this room of other traders, and kind of, I mean, talk about low, like, like low rating. It's like the stuff would have been rented from a surplus place. I mean,
Right.
really, you talk about unattractive offices and environment. So it was interesting to me that all that even though you think somebody like that would, well, I mean, it's like, might as well have a nice, and then it didn't register. It just was like, and the same thing, by the way, with somebody like Steve Cohen. I
Hmm.
remember the exact same thing. So when I interviewed Steve Cohen, again, I mean, here's a guy, man, he's made billions. Uh, and again, he had his office, but when I interviewed him, he's on the trading floor.
Right.
And you couldn't, if you didn't know what Steve Cohen looks like, you wouldn't have any idea who Steve Cohen is because there's a big trading floor and kind of in the not exact middle, but sort of in the midst of this is a desk, just like all the other desks. And there's Steve, uh, and it's like a bunker. I mean,
Yeah,
like a large bunker because there's no windows. It's not exactly, an attractive, but he's just kind of in there with the troops basically, and sort of. So I kind of remember sometimes because you have this image of what these traders' offices are going to look like and whatever, and it could be sometimes so radically different that that's what sticks with you as a mental image.
for sure. And obviously, you've interviewed investors and traders of completely different styles, buying strength, buying weakness. Were there any commonalities, especially when it comes to their mindset and approaches, that really stuck out to you that you think kind of led to their success, regardless of their strategy?
Yeah, well, mindset, the mindset of a trader, there is a lot of commonality. I mean,
Hmm.
the personal personalities, no,
Yeah.
you have people who are like drill sergeants, and you've got people who are kind of quiet, almost
Hmm.
shy, you're very soft spoken. And you got people who are really nice. You got people who are rude. I mean, you've really got a kind of and you've got left wing, you've got right wing.
Hmm.
You got personalities. It's just like I think if you took a random sample of people, you would get, and education. You got PhDs or near double PhDs in math and physics, and you've got people who didn't finish who finished high school and not with very good grades.
Right.
So you've really got all that's different, but the mindset that I think there's a commonality of kind of an intensity of focus
Hmm.
on on the trade of trading,
Hmm.
as a trade, as an endeavor, uh, the ability to lock out the emotional side, to treat it as a task without letting your human emotions get in the way. There's one exception I can talk about, but essentially, uh, as Bill Eckhart, who is Richard Dennis's partner and his CTA in his own right, as he pointed out, he made the very nice point that people are so poorly attuned to trading in terms of the way we've evolved our natural instincts that
Right.
people will do worse than random. And so people are not confused. He's led it with the cliche about monkeys throwing darts at the Wall Street page and doing this as well as professional traders. Eckhart's point is no, the monkeys will do better because people's instincts will actually lead them to do worse than random. That worse than
Right.
random is really important. And so the people who are successful are able to not react to this the emotional side and to be very focused, to be very prepared. Um, and in this latest book, Undiscovered Market Wizards, probably, I'm sorry, Unknown Market Wizards,
Hmm.
probably more so than in any other book of the series, you get this so many of those traders that make such a big point about being in a round mindset, right mindset, and if things not going right, close the book, walk away, come back next day or whatever. Uh, to be really, to do mental preparation before a trade, to get into a state of flow, to get a state of focus. All of these things, you see this repeatedly. How important the psychology is
Hmm.
to the art of trading. It's not just a matter of intellect or approach or even money management. That is really about having the right mindset to execute and to be aware of your own weaknesses to and in like one trade like Richard, there's not actually a few traders who do this, but one who's kind of exemplary at it, like Richard Barge, who will like keep a spreadsheet of a number of different types of emotions, and every day, whenever he's committed any of those emotional sins, we'll make a check, and at the end of the week, we'll look at the spreadsheet and see if any column has more than a couple of checks, and know that's an area where he has to work on, besides also keeping notes on all of his trades. So you see this is kind of common ground. You see this respect for learning from mistakes that comes up again and again and again.
Right.
A number of traders in this book talk about, and not only talk about it, bring out these 1,000-page binders with notes on all the trade, the trades, their emotional state. You can see this is a really serious thing. And the point of that is they're trying to learn from what they've done right, more importantly, from what they've done wrong. And kind of the king of learning from mistakes, one who makes it maybe most instrumental. And a number of these traders actually, in fact, one trader sort of idealizes it, is somebody I spoke about, is Ray Dalio. And Ray Dalio's maybe guiding philosophy is you have to learn from mistakes. And he that's his philosophy, not only in trading, but in general. In fact, he kind of makes a nice point about our educational system, how it's misguided, because it's always geared to getting the right answer. Yeah. And his point is, you don't learn by memorizing the right answer. You learn by, trying to get the right answer, making mistakes, and seeing what you did wrong, and going from that. So, but that kind of permeates his whole philosophy, and certainly Bridgewater is built on that. And according to him, at least, the development of their trading model is totally a function of their having incorporated mistakes into improving the model as years went by. And so you get that in this book. And like I say, one trader, in fact, there's a story about Dalio, who kind of bid to have lunch with Ray Dalio. And I won't go into the whole story, but we'll just leave it at that, whether he got the bid or not, because it goes back and forth a few times.
Right. And I am curious, though, you said they had tons of different personalities, but was optimism a common thread among them, or really there were pessimists, optimists everywhere along the spectrum?
I wouldn't say it's pessimism. I think it's confidence.
Yeah.
And sometimes confidence that seems almost misguided. So if you look at somebody like Marcus and that first chapter in that first book, and you go through his early, his trading experiences like a litany of failure after failure after failure. And I literally asked him kind of midway, hey, did you ever think it's just maybe this isn't your thing? Maybe you're not suited for this thing. And somehow he said, no, I just felt that I could do it. And he did. He went after blowing out a number of times, including, and he came from a poor background. His mother, his mother had like a little bit of savings, not much. And he even borrowed money from his mother and blew most of that. I mean, you couldn't get lower than he got. And he goes on eventually to finally figure it out and finally develop his method. Of course, risk management was a big thing that he didn't have initially, that he eventually got through these experiences. But he goes on and then turns a $30,000 account into 80 million. So, so it's the confidence, even if it seems misguided. There's some sort of burning confidence in these people, and they just really believe in themselves and their ability to succeed. So I don't know if that's optimism. I would just term it more optimism rather than confidence rather than optimism. Yeah. And pessimism, I don't think pessimism would work to be a successful trader, because again, it would fight the confidence element of it.
Right. And I'm just kind of curious, do you think anybody has what it takes to become a trader at the level that these people are, or you think that inner confidence is something you're kind of born with versus what you can develop over time?
Well, confidence is maybe, it's not just the confidence, it's kind of the particular skill or combination of skills that's required. So the answer to your question is no, I don't. For no more than, if you ask me, do I think anybody could become a solo violinist with a major orchestra if they practice enough? I'm sure they couldn't, because there is some sort of innate talent there. Could anybody run a world-class marathon time? No, they could run a marathon, but they won't run a world-class marathon unless they were born with the right body. People who don't have the right body, no matter how hard they train, they'll never be able to do it. It's just physically impossible. They can do very well. They might become the best runner of their weight or body frame, but they can never be world class unless they have a certain body type.
Right.
So anyway, but I think trading is the perfect analogy. I don't think anybody can become a market wizard. I don't care how dedicated you are, but it's a combination of a certain type of innate talent, and a talent could be different. It could be somebody like if it's somebody like a Michael Marcus, or in this latest book of Jeffrey Newman, just seem to have a kind of a real instinct for picking up trends early,
Right.
and it's just a skill. And like in Michael Marcus's case, I kind of make the point where there could be 100 things affecting the market, but his skill was to know which of those 100 was the thing that really mattered.
Right.
And I might be trading the same market. I might have analytical economic background and all that, know a lot more than he does in a sense, but he's gonna be right and I'm gonna be wrong because he knows which is the item that the market is gonna pay attention to. And that's kind of a skill. And like Newman sort of in his latest book will pick up these trends when they're really nascent, sort of, and he'll ride these things and he'll literally make sometimes even, to get 10 to 1. He has trades where he's made 100 to 1. And then he'll get out and the thing will go all the way back to where it was. So I don't care who you are. I mean, he talks about how he does it. He talks about what he thinks. He talks about what tech. He tells you what he's doing, but I think, could anybody do it? No. I mean, he can tell you everything he's doing. You'll never do it because it's a certain type of instinctive skill. So you have those type of traders who have this type of instinctive skill. You have traders who are like Annette Thorpe, who are just absolutely have this combination of quantitative brilliance
Right.
and creativity, and are able to kind of, before everybody else, figure out inefficiencies in the market and trade them for years before anybody else figures it out. So in his case, I won't go through all the things, but just as one example, he kind of figures out the Black-Scholes model or the mathematical equivalent of it, years before anybody else does. And he's really printing money for years before the paper comes out that, the famous Black-Scholes model. And, it becomes more common knowledge and it's programmed, but he's been doing that for years. And then he goes on and he figures out, the convertible arbitrage before that's, and then people start, and in statistical arbitrage, and, like so many of the hedge fund strategies that eventually become kind of their own boxes in the hedge fund strategy universe, he's the first guy that figures it out. So can anybody do that? You can have brilliant mathematician. He may, it's not just being a brilliant mathematician. It's also he has this insight and creativity to take this math and his quant knowledge and yet see how markets can be exploited. So you have people in that. So again, it is a very special combination of both quantitative skill and creativity. I don't care who you are, only very, very few people can be able to do that. And you can go through different approaches where people have this particular skill. And, everybody's got a different approach. But in each case, they sort of got this, they found this thing that they're really expert in.
Right.
And, and they could tell somebody everything they're doing, but you're still not going to be able to replicate it.
Right. And one of the things, Jack, that I find most interesting when I talk to the traders that I interview is about their routines and how they prepare themselves to be at the best of their abilities. So I wanted to ask you whether there was one trader whose routine really stood out to you that was really surprising or avant-garde or anything like that, that really just stood out to you when you're doing the interviews.
I wouldn't say, well, I just think of somebody like Amrit Zal in the latest book. And I mean, this is a guy who is, at least I did the interview a year and a half ago, but as of that time, he had literally had an average annual return of over 300%. Now, before people, say, wait a minute, that's impossible. He's not compounding it. he's basically continues to trade a few $1 million, and he's not. It's not like he's keeping all the money in the account. So part of the reason he's able to do that is because he's not letting his size grow
Right.
in a way that gets in the way. Um, I'm sure he could trade a lot more money and make a lesser percentage. But the idea is, but still, he can trade an account which is for most traders large. We're
Yeah.
talking millions, and have like literally 300% a year average returns. Not an average 300% for the whole period, but every year. Average return. So somebody, I mean, so his return risk is numbers, and he's a person who's the Sharpe ratio is really a horrible. I don't like the Sharpe ratio overall anyway because it
Hmm.
penalizes upside volatility. And he's the perfect example. He's got so many days where he's got these super large gains, but he almost never has a super large loss. So the Sharpe ratio won't give you any idea how good he is. But
Right.
something like a Sortino ratio, a gain to pain ratio, his return risk on those types of return risk measures, which don't penalize upside volatility, are literally just kind of completely off the charts. I mean,
Right.
you have everybody else down here, and he's like this outlier, way off. His return to risk is just extraordinary. So, talk about preparation. I mean, first of all, he doesn't do a lot of trading. I mean, he may do some trades, but the key trades for him don't come up a lot. There may be
Hmm.
like a 6 or 9, I don't know, key trades he might do in a year, and those trades are often around some sort of major event, or if it's a central bank announcement or some release of some major number or whatever. And he does immense preparation for each trade. He will, like he's been keeping notes. I guess he's been doing this since 2007, so he's been keeping notes since the beginning
Hmm.
on every type of situation. He got his own record of how the market has responded in all these similar situations. He'll review that. He'll know exactly what he does. He'll do no matter how the news comes out. Um, he'll do mental preparation for the trade. He'll be totally focused. So he's somebody who does so much preparation for a trade, both
Hmm.
research wise and emotionally mental wise, that it kind of stands out as a kind of a pinnacle of how intense you could be about the craft of trading. So he's not the only one who does that. I mean, but he's a good example. If you ask me for an example of somebody that stands out in terms of trade preparation.
For sure. And you mentioned a few ratios here, performance metrics, the Sortino ratio. Could you talk a little bit about how you analyze the performance of a trader? What are your favorite metrics? And for those
Sure.
people who don't know what those are, kind of explain this a little bit too.
Yeah, sure. I'll give you that. So one thing is I'm not a big fan of return alone, and 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 that's why people. I mean, people look at return, by itself, and they a lot of people just look at that and they stop, and just to give your audience a simple example of why I don't think it's a good metric. Uh, take any trader, and or yourself. I mean, I'll tell traders, hey, you want to double your returns? I can tell you to double your returns. Just double your positions trade every time. So you'll double your returns, you'll double your losses. Does it make you a better trader? No. I mean, it'll mean like, okay, instead of let's say you're making 20%, you'll make 40%, but then your drawdowns instead of being 20%, will be 40%. So
Right.
it doesn't make you a better trader uh, because return by itself doesn't mean anything unless you normalize it by the risk taken to get that return.
Right.
So that's why I tend to almost focus solely on return to risk. And as far as the most common return to risk measure is a Sharpe ratio, which takes the average annual return, divides it by annualized volatility. And so the problem with that is volatility is a proxy, but far from a perfect proxy for risk. Volatility and risk are not the same. Yes, for some traders and in some situations, volatility can be a proxy. So if you
Hmm.
get greater volatility, you'll have greater risk. That's true if you're doing something like doubling a position. You double a position, you'll double the volatility. Yeah, it's true in that. It is true maybe for some approaches, but there are a lot of trading approaches where that's not true, where volatility is not a good risk measure. And we talked about like Amrit Saul, which is a perfect example. So here's a guy who must have like 30 days in his track record where he's made 25% or more on a single day. Okay.
Right.
So the Sharpe ratio will hate that because it's so much volatility, but it's on the upside. And yet he has very rigorous risk management. So if he's wrong, he gets out right away. The one time he had a big trade, and I'm not going to go through the story, but the story's in the book. It's like a critical trade. He puts on the trade, and he, the announcement's being made, and then the sentence is finished in a way where it completely reverses the trade, and his computer, and he can play Microsoft here, starts powering down. It was some sort of Microsoft. Starts powering down right at that moment. So that's the one time he took a big loss. It was just like an extraordinary, bit of bad luck. But other than that, he didn't have like any large, even though he has so many big gains. So for somebody like that, the Sharpe ratio is going to give you a very misleading picture. So my point is, and so you have traders like that who have asymmetry. They have large gains, but not large risk. On the other hand, you have traders like sellers of out of the money options, and this is kind of a strategy on its own. And the thing about this is these guys will have good records for years, great records, and super Sharpe ratios. Why? Because they're selling options that could expire out of the money in almost all cases. So every month they're making money. So you have these track records, and you can see this over and over again. You'll have these track records that look like a money machine, just constantly making money. The Sharpe ratio will love it because you have steady return. Hey, look, almost like Bernie Madoff, but with real money, up to a point. And the point is, if there's let's say there's a sudden sharp down in the market, like March 2020, or certainly 2007, 2008, or even 2011. But you get these certain times where you have these quick large breaks in the market, and then what happens is these out of the money options. Particularly on the downside, where they not only they start losing in those, but those positions become larger and larger because as the market goes down, the delta goes from like 0.1, meaning they move 10% of the amount that the underlying stock or market does, to moving 0.5, half as much, 0.75, ultimately close to 1. So the position is getting much larger. At the same time, everything's going against them, and the more it goes against them, the larger it gets. So you have tons of cases of these type of traders where they've had great records, and then something like this happens, and they literally have an 80%, sometimes 100%. They wipe out completely, but it's sporadic. It's once every number of years, and that number can be large sometimes. So it looks like they have good performance. The Sharpe ratio would tell you, hey, put all your money with this guy. But the point is, the risk is hidden because it's sporadic, only comes up once in a while. So my point is that's why the Sharpe ratio I don't think is a very good measure. Yes, 99% of the investment community uses that, but that doesn't mean it's right. Lots of times the majority of people do stuff and it's wrong, and it sort of self-perpetuates. And so I think it's just common sense, right? What is the measure of risk? Ask anybody. You don't have to be a mathematician for this. You don't even have to know math, but ask people, what do they consider risk? Risk is losing money. It's common sense. So if you're going to have a measure that means something that really coincides with people's perception of what risk is, it should be a measure of losing money. So you've got stuff like Sortino ratio, which is like the Sharpe ratio, but it only uses the downside volatility, the volatility on a losing side, not winning volatility. And that's much better. That's a big improvement. I'll just write a real tangent here. I'm not going to go into it. It's just that the way people calculate the Sortino ratio is wrong for technical reasons. If you want to see the answer, it's in the book Unknown Market Wizards, or you can go to fundseeder.com and look up or if you hover over any of the risk metrics, return any of the performance metrics, If you hover over on it, it'll give you the definition. And I think actually there's actually a separate page of which gives you all the explanations. And in there it'll explain to you why the way people calculate the Sortino ratio is wrong. It still gives you the right ranking, but it makes it not comparable to the Sharpe. But if you do it correctly, it is comparable to the Sharpe. So I won't go into that tangent though. But anyway, so the Sortino ratio is a good one. And then there's one of my favorite measures, the gain to pain ratio, which again is explained in the book. It's explained in the fundseeder.com site. Essentially, you're summing all the gains and you're summing all the losses. Ideally using daily data, but you can use monthly data. Just the two are not comparable. There's a different, what's good for monthly is not good for daily. Again, that's all explained. But that idea of using a ratio of all the wins to all the losses is very good because it's basically normalizing the gains by the losses. And if you're using daily data, every loss you take counts, which is why I like it. So you can't hide anything. So even if you have a month where you end up losing 2%, but intra-month you were down 18%, that doesn't get hidden if you're using daily data. So something like a gain to pain ratio based on daily data gives you, and plus the daily data, you have a lot more data, because it's daily, you got
it's more granular,
22 times as much data for the same period as you have with monthly data. So that, I think that's one of my favorites. So those two, just what I call the adjusted Sortino and the daily gain to pain ratio are my two favorite stats.
Perfect. And while you've done all these interviews, have you learned about any or noticed any common risk management techniques? Because risk management is really the name of the game. You can't trade without your capital. So what are your thoughts on risk management, and did you notice any similarities between all the different traders you've interviewed?
Yeah, well, risk management is not rocket science. I mean, you can make it complicated. There's people who've written books or even multiple books on risk management, which is kind of, in my mind, a bit absurd, because literally I can get 90, 95, 99% of risk management down, not only on one page, I could probably do it in one paragraph. I might, maybe one sentence is pushing it, but I can certainly get it in a paragraph. And the essence, and this is what you see in traders over and over again, the essence of risk management, and hey, to your audience, if you get one thing out of this whole hour, whatever we talk, this is just take this, and this will make it all worthwhile. The essence of risk management is just to not let yourself lose much on any given trade. I mean, that's all it is. I mean, really, that gets you 95% of the way there. As long as you don't let any trade lose much of your total equity, you're most of the way there. And it's essential in order for you to succeed. And the idea of what is not much of your equity, most people overestimate it wildly. When I wrote the original Market Wizards, I think in my conclusions, I suggested that, you shouldn't risk more than about 1%, on any given trade. And then in 2000, that was written in 1988. And then in 2012, I did a revised version where the original text is not revised, but I added a chapter saying, hey, 25 years later, whatever it was, looking back, what are my thoughts now? And I added that chapter of, how I kind of view things 25 years later. And I think the only thing I said that I would change that from the original, I mean, it really was remarkable how much of it still seemed totally valid.
Right.
And one thing is maybe as far as the maximum risk, and maybe, I wouldn't say 1%, or maybe I used 1 to 2% in the first book. I'd say it should be less than, should be a fraction of 1%. Mm-hmm. So, people think in terms of 5% or 10%. No, that's way, way too much. Literally, we're talking 1% and under in terms of what you should risk in any trade. So that is kind of the essence of risk management. Then you get behind all these traders and what they're doing. It all comes down to almost always to not risking too much on any given trade.
Right. That's key.
I mean, there are other elements. There's diversification, and there's stopping the trading when you're starting to perform poorly. There's other elements. I don't mean to oversimplify it, but the most important element is not to let yourself lose too much on any single trade.
For sure. And anybody watching, write that down, what Jack just said, for sure. And Jack, I thought, I just thought of this question. I think it's a really good one. It is, what historical trader during any time in history would you love to sit down with and interview if you got the chance?
Well, I mean, the person I've never interviewed that was always kind of on the top of my list, and it was not for not trying, was George Soros.
Hmm.
So, uh, no question, if I was going to interview anybody, Soros would be the trader that I would most have liked to interview. Uh, for a number of reasons. I mean, as far as discretionary trading, he's no doubt. I mean, if he's not the best of modern times, he's got to be in the top five or whatever,
Yeah.
But he may be the best. Um, and there's so many insights he's had, and just remarkable trading stories and trading talent. Plus, he has an interesting background.
Yeah.
Besides trading, having escaped from as a child from World War II, as a Jewish child,
Yeah.
and then trying to convert the communist world after the wall came down to capitalism, and that didn't quite work out. But he made that effort, and the experiences there. There's a lot of elements of it. So he's kind of a person who I think whose life story and his insights about trading would have been great. But like I never spoke to George. I never
Hmm.
got past his coterie of people, uh, and I even interviewed Druckenmiller, who ran Soros's funds during the time he was, in Eastern Europe and Soviet Union, ex-Soviet Union, Russia, trying to influence those countries towards democracy and capitalism. Uh, and Druckenmiller, of course, is a great trader in his own right. But I think, and Druckenmiller I had him ask, but even that didn't help. So I just, whatever reason, I couldn't get Soros to agree to an interview. So that's the answer.
For sure. And what is your favorite interview that you've done over the course of all these years?
Oh, that's hard. I would say one one hint to it. My favorite is you, typically is look at the first chapter, but it's not
Yeah.
always. But so Michael Marcus in Market Wizards is one of my favorites because he was so open and honest, and he had such interesting stories and a lot of good trading advice.
Yeah.
It's also one of the longest interviews. One of my other favorites was Ed Thorpe in
Hmm.
Hedge Fund Market Wizards, because again, incredible range of stories, including his whole experiences with beating the casinos at their own game, which sounds impossible until when you read how he did it. Essentially, he did it with physics, not I mean, not that you're trying to come up with a number like a betting system based on the history of, say, roulette rolls or something like that, is kind of a fool's game. But no, he kind of used Newtonian physics to do it. So, but from those stories and the attempts on his life, at the for beating in the casinos to all the hedge fund strategies he developed, to just a long life. And so that was one, and that's the longest chapter I think in any Market Wizards book. So that's certainly one of my favorites.
Hmm.
Bill Lipschitz, I've talked about the first chapter in New Market Wizards. I think just had some incredible stories and insights as well. So I mean, there's quite a number. I don't mean to rule out any others, but these are just some of the ones that come up. And I tend to like ones that not only have trading lessons, but actually have just compelling narratives that
Right.
would almost read as like fiction. So
Right. Right. And what are some of the biggest takeaways that somebody reading your book that you want them to walk away with after reading any of your Market Wizards books?
well, I think if people read it, they should come away with an understanding that the books are probably more about psychology than about trading.
Right.
Uh, that that almost every trader gives greater weight to risk management than the methodology they're using. That you can't, if you're looking for somebody to give you a trading methodology on a silver trade, you haven't gotten to the point of even asking the right question, because you'll see repeatedly that people use their own approaches, even if they, doesn't mean you can't learn from other people, doesn't mean you can't be influenced. But if you try to copy their approaches, unless by some fluke your personality is perfectly aligned and skills are perfectly aligned with what that person's doing, it's not going to work because you're not them. So you can learn from other people, but you still have to make it your own approach. And so another very, very critical lesson that should come across is, hey, to succeed in this game, you've got to figure out what your own approach is, and it's not going to be obvious. You'll see a number of cases where people start with one thing and end up with another, and whatever you start out with may not be what works, may not be what you end up doing. But you have to be, and that leads to another thing, which is, I was going to say, you have to be flexible enough to change. That leads to the whole concept that the people that are good at trading, are flexible. They can admit they're wrong. They can admit that they made a mistake. In fact, I'll throw this out, and I'm now going to alienate 40% of your audience, if they're typical of the nation overall. I threw in one kind of like humorous line. I thought it was humorous. I put it as a joke, but I thought it made the point. And I don't get too many one-star reviews on any of my books. There, you go to any of the books and on Amazon, you'll see they're almost all 5s or 4s, and occasionally you have a few 1s. But his last book, the same thing. I mean, it still has, I don't know if it's a 4.7 or whatever. It still has a very high rating, but you'll see a few 1s or criticisms. And they picked up. I had one line, and it's just amazingly. But I'm bringing this up because it leads to the thing of flexibility. And I said, and I'm paraphrasing it, maybe it's exact, but it's pretty close. I said, I was trying to make the point that to be a good trader, you have to be able to admit you're wrong, to change your approach, to change your mind. And I said something like, politics aside, all I could say, if Trump was ever a trader, I am sure he would end up losing because he has never admitted he made a mistake. And so that pissed off, but I thought it was real. I can't think of a single time he said it. Well, if you like him or you hate him, I couldn't think of a single time where he's admitted he's wrong. No matter what, even if he's dead wrong, he'll never admit it. So I thought it was a fair analogy, and I thought it was a little humorous, but not if you're a Trump fan. Apparently, very, very thin-skinned. So. But I thought I was trying to make the point that you have to be able to admit you're wrong, and I believe if he ever traded, he would be a lousy trader because he doesn't have that flexibility. But anyway.
So to kind of say it another way, it's hard to be a really stellar trader if you let your ego kind of get in the way of decision making, basically. That's really it. You don't. So having an ego, in fact, that's where people go wrong. It's an out of ego. I guess, Schwartz, had years where he lost money. Then he goes on to this phenomenal, just mind-boggling performance, which at the time I had interviewed was like 10 years or so. I mean, he couldn't keep up that performance. It was a ridiculous rate of performance. I think it was like 25% average per month, some really crazy number. But he had a long phase there and he still continued to be successful, but just extraordinary performance. But I asked him, how did he go from winning to losing? And he said, I became a winner when I understood it was okay to lose. And here's the key line. He said, what is the rallying cry of a losing trader? I'll get out when I'm even. And why is that so important? Because if you can get back to even, you could say, I was not wrong. I did not make a mistake. And then need to protect the ego is exactly why people lose. So when you talk about that ego protection being a flaw, that's exactly it. I mean, that you're paraphrasing Schwartz's point, which when I give talks, I almost always include that because I think that's
one of the most insightful things anybody has ever said in any of my interviews is why people lose. It's because they're trying to protect their ego, and that's a recipe for disaster.
Yeah, there's somebody I respect on Twitter who, in his Twitter bio, he's a great trader. He's a professional loss taker. I love how he put that there. You have to be willing to accept those small losses over and over again in exchange for that performance.
Yeah.
You got to protect yourself from the big losses, which is what's going to set you back.
Yeah, yeah. But taking losses. I mean, a lot of number traders will say that my job is taking losses. I mean, it's
right.
But in a methodical way where it doesn't hurt your account. And almost all traders pay more attention to that. So somebody like Peter Brandt, who is chapter 1 in this latest book, he talks about he's looking for points where it's not that he'll think the market can have a significant move in a given direction when he puts on a trade. But what he's really looking at is where can he put on trades where he can put a meaningful stop that doesn't lose much money. His whole focus of what defines a good trade is where can I put on a trade that makes sense, that's not going to lose me much money when I'm wrong. That's his driving force. It's not how much can I make on the trade. It's where can I put a trade that has a reasonably good shot of return where I'm not going to lose much. It's still not losing much that drives his trades.
100%. Yeah, that's wonderfully put. And I want to ask you, outside of your books, which of course I really enjoy and are excellent, what is kind of a list of trading books that you think would be great for newer traders to pick up, and do you think would really help out their trading journeys?
Yeah, well, one book that a lot of your ones may be familiar with, which influenced me, actually was an inspiration when I wrote the first Market Wizards book, because that was kind of my mental image of, hey, I'd like to be able to replicate that, is Reminiscences of a Stock Operator, which was a book written back in the 1920s. And even though it's talking about an era, where we had bucket shops and things are completely arcane, are obsolete, now. But so many of the comments, the protagonist. It's written. It's not by Jesse Livermore, but
Edwin Lefebvre.
The protagonist is clearly a fictionalized Jesse Livermore. But so many of the things that he says sort of resonated with me when I was reading the book 65 years later. It's now 100 years later, but and would still make sense. And so I think when I talk about going back my own Market Wizards book, where I read it 25 years later, it's still what I was shooting for was to get these truths about trading and markets that sort of don't change no matter how much markets change. And so that's kind of a classic book, which is still relevant today, even though the markets bear no resemblance to what they did then. I mentioned, Brandt, by the way, we talked about Brandt. He wrote a book where I think died with a professional commodity trader, where he took a year of his trades and sort of died, just in real time, and why he took them and how he managed the risk. And that's kind of, if you're into if you're a chart trader, that's kind of a good book because it shows you how to mesh chart trading with risk management. Basically, I don't read, I actually don't read trading books. It's probably the last because, it's not something it's just not what I go to read. I may read about books about markets, but they're books which are more kind of, they're not about how to trade. They're books like When Genius Failed, a book I recommend, When Genius Failed, by Lowenstein, which is a great in-depth narrative on the LTCM thing. There's one of my favorite writers, I think books like The Big Short, and his first book, The Liar's Poker. So those are not how to trade books by any means, but they're great stories. They're great fact-based stories about markets, and so those are the types of books that I like. So it's not, for people looking at how to become a better trader, those are not the type of books that are going to do it for you. But that's the kind of things I gravitate. If you go on to Quora uh, and look up, yeah, I don't contribute, haven't contributed for a while, but at one point I was making contributions, and then somebody asked the question of one of my favorite books, and I did list a number of books there. So if people want to get that list, go on to Quora, put my name in, and one of the questions that I answered was a reading list.
And just specifically, we've talked so much about how important mindset and psychology is. Is there a mindset book that you think is really helpful? It doesn't have to be market related, but something like I really enjoyed Atomic Habits by James Clear. That's one I really enjoyed. But
Yeah.
love to hear your perspective.
Oh yeah. So I'm sure there are lots of good books like that. I haven't read that. I haven't read that group of books
Right.
to be able to recommend any I can think offhand. Yeah, so there are lots of books out there, but I haven't read them. So I can't make a recommendation there.
No problem. And going back to reminiscence of a stock operator, Jesse Livermore would have been a fantastic interview. That would have been really something, wouldn't it? I mean,
I suppose yeah. I don't know if Edwin Lefebvre interviewed Jesse Livermore.
Yeah.
But I don't know how else he must. I never saw any references to him having interviewed him, but I don't know how else he could have written about it.
Right.
Because so many things are basically thoughts. So that it was very hard to find. I wrote 75 years after the book came out. I was asked to do it then became like free publication. The rights sort of expire, and there was some publisher was doing a 75-year anniversary. They wanted me to. I wrote a preface, so I went. In fact, I remember going. This is pre-Google, but I remember going to the library in the 42nd Street branch in Manhattan, like the biggest library, and we go back, and I was digging up old microfiche and Times on whatever I could find. It was very hard to find. I found some information about Lefebvre, but I couldn't find much information about I didn't find any references to interviewing more, but I imagine he must have. I even spoke to his grandson, but I just it was just a limited amount of information that was available.
For sure. And I'm curious to hear about how you find market wizards. Of course, you've got your platform Fundseeder, which I love to hear more about. But yeah, what's kind of your process, especially for the most recent book, Unknown Market Wizards, to find these individuals?
There were multiple. There were several ways. There were actually three ways I found everybody in this latest book. So one, as you mentioned, was Fundseeder, which is a platform which is basically a trader platform. People can get free performance analytics and stuff like that. Our goal for doing that platform is to be able to find undiscovered trading talent, and so there's Fundseeder Technologies, which is the platform, and there's Fundseeder Investments, where the game plan was for Fundseeder Investments to use the database from the technology side developed to find traders to use for investment products. And in fact, the first Fundseeder fund is, if it doesn't, hopefully it doesn't get rescheduled, but as far as I know, the latest information was a shooting for a December 1 launch. So it's very close. So, but it's just now getting to that point. But anyway, that's Fundseeder. Anyway, so some of the traders came from Fundseeder. Some of the traders I just knew. So like somebody like Jeff Newman had contacted me before I ever decided to do the book, telling me about it was kind of one of those unbelievable emails, like I took a $5,000 account to 50 million. And, your first response is, yeah, sure. But, I kind of know that sometimes these stories are true, and I never take these unless I can prove it. So at the time I wasn't planning to do the book, I said, well, look, I'm not planning a book, but just in case I ever do, I'll keep your email kind of this. I'll save your email. And if you can prove, the story, it certainly sounds like it. Then I'd say, sure enough, when I got around, for reasons, I just decided to do the book less than a year later. And when I decided to do it, I got in touch with him, and he literally sent me every monthly statement, for all those years. So, I knew him though because he'd contacted me. Somebody like Chris Camillo, who was a fascinating chapter in his book. Won't go into it, but let's just say here's a guy who doesn't use fundamental analysis, doesn't use technical analysis.
Social media, right? Yeah.
Yep, social media. Literally came up with his own methodology, like incredible, and done extraordinarily well. Right. So somebody like him, he wanted to meet me for unrelated reasons. I said, he's in Texas. I said, you want to fly? I'm Boulder, Colorado. I said, although now in Winter Park, I've got two places. Anyway, I said, you want to fly out and, meet me? I'm happy to have lunch with you. So I kind of knew it, but he started talking about he told me some of his background. And hey, that sounds like it would be. So I knew some traders like that. And the third group of traders, what I did is, I don't have a large Twitter following. I think at the time it was maybe 50,000 or whatever. But I basically put out a couple of tweets saying, hey, I'm going to do a new Market Wizard book. If you think you are a market wizard or you know anybody who is, send me this. And I got hundreds and hundreds of recommendations. And out of that, a few of them led to the interviews in the book. So those were the sources.
Perfect. Any plans for another one, or
no? But to be fair, I never have plans for another one. So the first one, I didn't have plans, but it was such a big hit that I did end up doing one. I thought I might as well do another one. And I had the trouble wasn't the trouble, but the fact was that I had a number of traders I didn't get to use.
Right.
Well, the first one, which I knew would be good interviews, and I also subsequently learned. So I knew I had material for a second one, and it was such a big hit that I think, well, okay, I'll do a second one. But I never intended to do. That's what I thought, But then I ended up doing, let's say about 8 years later, I ended up doing a third, and then 12 years later, I did a fourth, and then I guess about 8 years later, I did the fifth one. So, there's been like a cycle of not exactly 8, other than the first two. There's been a cycle of 8+ years. I don't intend to do another one, but one never knows.
Right. And this is a little bit of a selfish question for myself, since I do interviews as well. But how do you decide what questions to ask each trader? Do you do a lot of research beforehand so you kind of know what to expect, or is it all in the moment, as you said, just kind of going with the conversation?
Yeah, I do some research, not a lot of research. Where there's stuff available, I'll look at it to have some idea. But it's not a ton of research. By and large, is what I said before, is that I will just have a conversation,
right?
And I'll listen to what they answer. I'll try to go off what they answer,
right?
And that's really the key. And willing to give it as much time as they're willing to give it.
Right.
Sometimes those extra hours don't lead to anything. Sometimes they lead to the best stuff. You never know.
Right. Perfect. And Jack, thank you so much for your time. I always like to kind of edit out with this last question. What advice do you have for new traders who maybe just got started in the last few years, who are trying to find a system, trying to become more disciplined and get to that level of performance and become consistently profitable?
Yeah. So if you're a new trader, basically, I think the first thing is kind of learn. You gotta. So, and that means like you read a lot of stuff, whatever your source is, whether it's off the internet or it's books or whatever. And the idea there is not that everything you're going to read is going to be worthwhile. Some of it may well be misleading. I talk about in one of my books. I talk about the misleading, the well-chosen examples. You have to be kind of attuned to people who will do that, but you can certainly get ideas. And right. The point is, you're just looking for ideas. Then you want to take things that resonate, that seem to make sense with you, that you feel comfortable with, and try watching markets and applying those, not with real money, but just seeing how those ideas seem to work, and try to develop a methodology. And I usually advise paper trading before people go to real money, even though it's not the real thing. But if you can't be successful with paper trading, you're certainly not going to be successful with real trading, with real money. And successful paper trading doesn't guarantee it, but unsuccessful paper trading certainly will save you money until you're not ready. Now, when you seem to have some sort of methodology that seems to work, then start with an amount of money you can lose. And what I basically say is, whatever amount, let's say you say, okay, I got $100,000 here. If I can lose it, my life doesn't change. I still have my day job. But don't bet the whole 100. Say to yourself, okay, I've got a methodology here, and if I'm right, I shouldn't really lose more than 25%, as an example.
Right.
So you make a promise to yourself. You say, okay, I'm going to use the 100,000. I can margin fully, whatever. But if at any point my equity goes down to 75, the market's telling me what I'm doing, it just ain't working. I'll blow out of everything, go back to the drawing boards, come back in a number of months and try it again. That means you get a second chance. Lots of people blow out in the beginning. So you don't want to shoot the whole wad at one time. It's like it's just common sense that you want to make sure you have chips to come back into the game. So that's what a lot of people do wrong, is they start too early, they bet too much, they risk too much, they don't allow for them to blow out. And I think if you pre-plan that you're well ahead of the game.
100%. I think that's well said. And like you said about risk management, less than 1% of total your portfolio size on any given position. That's a good rule of thumb, especially to start with. A lot of people take a lot of outside risk, especially starting out. Yeah. Jack, thank you so much for your time. It's really been an honor for me to get a chance to sit down with you and ask you questions. So thank you so much. I'll have your links to your Twitter, your recent books, which are highly recommended. That's a great way to kind of find a system that kind of vibes with you, is reading Market Wizards and just kind of choosing one trader who, that's kind of interesting what they're doing. So Jack, thank you so much for coming on once again.
Sure. Hey, thanks a lot. I enjoyed the conversation.
Awesome. And to everybody watching, I hope you enjoyed as well. Go ahead and leave a like down below and subscribe to the Trailline channel. And we'll see you guys in future videos. Thanks.
Okay. Thanks.